Thanks everybody for being here this morning. We really are looking for an exciting week in the markets. I mean, I got news for you. Last week was such a stellar week on so many fronts, besides being a fairly robust, profitable trading week. The markets are trading technically again. They're coming into supports. They're reacting a little bit different than most people may expect with the surprise email announcement yesterday. And as soon as Mary had come out and had told me that, I go, that's probably good for, I said, and I quote, 10 to 15 point higher opening Sunday night. I was way off. It was double that. So the market, as I wrote about and tweeted out when the FBI comment came, the market broke down, right? So the market itself, and I mean, I'm not here to politicize anything. I have refrained from that in the trading room. It's none of my business what anyone votes, what your beliefs are, whether you hate one or another. There's one candidate or another. There's a need for respect and reasonability and civility. This has been one heck of a opposite of those principles of an election. No one needs John-Person's inputs. So I've been, as best as my Irish temperament allows, been refraining. But with that said, and I do have a report card, and I do have a higher authority I report to, and that would be, as everyone knows, my wife, Mary. And she has been eyeing me very closely to make sure that I adhere to that. So with that said, I'm just looking at the markets and how they react, not my opinion. When it's news that Trump's going to win, the market goes down. When it's news that Hillary may win, the market goes up. And as we all know, if you don't, as long as Truman was president, the market goes up in Democratic terms. And, not that it doesn't go down, but more times than not, the theory is, or the principle of thought is that the markets go up because of what? Spending, et cetera, et cetera. So there are some programs that enact under Democratic rule that, as some people say, are slightly liberal, and therefore the term liberal conservative. So anyway, with that said, the market, here we are. And what did I mean by it has been trading technically? We noted that if we got breakdowns, now I didn't put these here this morning. These are old charts, and we're going to review the old charts to figure out what we've been saying. And in order to figure out where the market might go, let's ask ourselves, where the hell has it been? And when I say the market's been trading technically, it has been trading technically. It's just this summer we got into a very tight range, and we coiled, and we finally broke down, and we got to a level of support. And for the most part, all my weekly thoughts and observations had been targeting 208 in the S&Ps, and that was the number we hit on damn close to Friday. So what does it mean from here forward? The Russell was up at one point nearly 11% year to date. That was this high. We were up 11% year to date. And if I bring in my notepad here, you will note the weekly thoughts and observations, which I have haven't done for a while because it's more of a newsletter. But if you're new to the room and you're just visiting, you can, or if you don't get it, or if your email didn't come, or for whatever reason, you can find the Word document or the PDF or whatever I put in there in the file that I just at the bottom right-hand corner of your screen. You can see flashing in the file, and it's marked obviously 11-7. So we had quarterly support spiders. We have the Qs. We have the IWM. We've got the diamonds, and for the most part, the Russell, which was up 11%, is now only up 3.9. Well, let's call it 4%. It's up 4%. It's going to be back up to about 6% on the opening today. I think that, like any other day trade that we've seen, it's going to need a close, and I want everyone to listen. This is a quarterly pivot, blue. This is a last conditional change, high. If the market, this is a trend line. If this was a 5-minute chart, on a daily pivot. If I told you that this was a 5-minute chart on a daily pivot, a John-Person signature setup would be a close above that last conditional change high and the pivot. Now, we might get a close above this last conditional change right here, which was last week's high, and the pivot, which would be strong, but it would be a stronger move if we got above the high, which is 1231. Now, I understand we're at 1184, and there's a wide variation of pricing between the two spots. However, folks, I'm looking at the bigger picture. A bullish breakout trend will start to develop, in my opinion, from that level. So let me share with you what I mean by that, if the computer technology allows me to, because apparently I've drawn too many things here. There we go. All right, so now we're back on track. Now, there's two thoughts of chart patterns. Now, many of you have been to my seminars, your students, TTU. You know I have what's called the 12-person, the person's 12 bullet point of market analytics. Person's pivot, seasonality, COT. There's 12 things that I generally go through to make determination for market trends. Price pattern. Let's look at this. This may be construed as an inverted head and shoulders with a neckline that the market broke out. It came back and, oops, tested that neckline, and that is a valid trend line off a last conditional change, average of highs, average. So if this is the left shoulder and that's the right shoulder and that's the head, then baby, that is the neckline. And we came right down to the neckline, technically speaking. It also is a quarterly pivot support. If you look here, I've got quarterly pivots. So the quarterly pivot held support. So one school would say that if this is an inverted head and shoulders, a most powerful buy setup would be if the market is a failed breakdown of a head and shoulders. In other words, if this market is truly a head and shoulders, the test of the neckline, if this thing breaks out and takes out and starts to bounce back up, you get long on the proof that the market's up with your stop loss. In other words, you would get long on the breakout. So the market goes up, it pulls back, and instead of catching the falling knife, you wait for a reversal, you get long at the breakout point, and then your stop loss goes underneath the swing low. And then what you're looking for is a bigger reward, or at least the same reward as your risk, 1-to-1 or greater, what with higher probability. Remember, you're not buying the low of the move, you're buying a breakout, you're giving up the right of enormous profits for confirmation that the trend is moving up, and I've drawn too many lines. And so with that said, from a technical perspective, if this was a test and it is successful, it's going to come from a breakout, and then we would get long there with the objective of unbelievable rally up here. Now, this is a quarterly pivot. The quarter ends at the end of December. Is the market capable of moving there? Stochastic speaking, we've gone from overbought to now in an oversold neutral zone, right? The breadth analysis did come back down. Volume was meaningless in that decline. Volume was actually, in a longer-term weekly chart, meaningless in this price decline. In other words, it wasn't as strong of a volume as we saw with the price move. It wasn't as strong as a market move. It wasn't as strong a volume with that price move. You see what I'm showing? There were bigger movements in volume trends than there were on a 6% move. So you could look at this in terms of percentage. From that peak to that trough, close to close, was almost an 8% move. So at that same point in time, this was based on the week of 9/23. So on 9/23, where is it? Here we go. 9/23, if you look at the rate of change or the decline in the volume, 3%. Now, I've done a little bit of studying on this phenomenon. When you start to see moves and when you start to see valuations change in volume terms rather than price terms, okay? So instead of looking, this is ultra technically advanced information. Ultra, more so than most people want to hear about today. But what I'm saying is, statistically speaking, instead of coming up with a visual approach, I'm coming up with a statistical, numeric approach of the market. When we have seen pullbacks of that type of magnitude, we've seen movements that are significantly greater than 3%. Do you see what I'm sharing with you? 11, almost 12, 15, 21%. So when we look at moves in the market of that size of magnitude, it generally comes, if it is a for real decline, we generally get bigger volume.